Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Professor Richard Portis. He's a professor of economics at the London Business School to discuss sovereign debt, international capital flow, and the U.S. current account deficit. Professor Portis, it's great to have you with us. Welcome to Trade Talks.
It's a great pleasure. Thank you.
You got it. And let's start with the U.S. dollar. What will the dollar exchange rate depend on during the next several months?
I think essentially on differential interest rates. You might think it would depend as much on the state of the U.S. economy, the state of the European economy, and the rest of the world. But in fact, what's been happening over the past several months seems to show that it's interest rates that are dominating the story. And for a while, it was the U.S. leading in raising rates, and then Europe came along and raised rates. And we've seen exactly that. First, the dollar went up with the U.S., and then the euro has gone up relative to the dollar.
What would be the consequence of dollar appreciation or appreciation?
Well, it makes life difficult for the Europeans, and if you have dollar appreciation, it makes life difficult for the Europeans in the sense that it means importing inflation, and the European economy is more open than the United States to imported inflation. So that's one big potential consequence. And of course, raw materials are priced typically in dollars. And that, again, would bring an inflationary effect for Europe. But of course, the converse is for the United States that it brings a benefit. So, there are swings and roundabouts, but on the whole, if the dollar resumes its appreciation, that's positive, I think, for the U.S. and negative for Europe.
And certainly something that's getting a lot of attention. The U.S. current account deficit is now 4% of GDP at its highest since 2008. And overall, global imbalances have widened. Is this dangerous?
I think it is. This is something that I've written on a lot in the past and has occupied a lot of my thinking. And I believe that a significant contributor to the 2008 financial crisis was indeed the global macroeconomic picture that had developed at that over the period from, say, 2004 onwards, with huge U.S. deficits. And we're back to very big deficits, with the United States having an even bigger external debt than it did before. So that I think this 4% current account deficit is actually a serious number. It may be, looking at it from the United States, that it's the budget deficit and the current standoff about the debt limit that seem more important. But for the rest of the world and for the global economy, that current account deficit is a big deal. And the global imbalances with a certain set of countries that have big surpluses, not necessarily the countries that you want to have big surpluses.
And despite monetary tightening in the U.S., emerging and market countries have not seen major capital outflows. Why is that? And are there any risks ahead associated with that?
It's very interesting that I confess that 6 months ago, I was saying the emerging market, you could see this U.S. tightening coming, and the emerging market countries were going to be in trouble with big capital outflows. But the fact is, and what I think none of us really were noticing very much until it became clear, is that the emerging market countries were already raising interest rates. And so by the time rates started to go up significantly elsewhere in the world, they were, in a sense, they'd had their defenses raised. And so you haven't seen big capital outflows, the kinds of capital outflows that I and many others had expected.
And just a couple of weeks ago, the managing director of the IMF was warning of a major global recession. But at Davos, the first deputy managing director said things are looking up, while the World Bank's latest forecasts are still very gloomy. Why is there such a divergence of opinion here?
Well, let's ask first whether there's a divergence of opinion within the International Monetary Fund. And I'm not too well placed to comment on that, perhaps, being an outsider. But it seems to me that views have changed rather sharply in a very short period of time. And that may reflect differences within the institution. The World Bank across the street, on the other hand, takes the view, understandably, takes a view that is more influenced perhaps by the troubles of some of the very poorest countries. And many of those countries are in deep trouble because of their external debts.
And let's talk about that. To your point, the poor and emerging market countries, some of them have very high levels of external debt. So are there crises around the corner because of that? And what is China's role in this? And why won't it work with the Paris Club?
I think we have, in fact, dozens of countries now that are in deep debt distress. And they're going to have to be worked out, whether the workouts come in the form of defaults or rescheduling debt or whatever. A lot has to be done. In good part, in the past, that has been done without the necessary intervention of the IMF and IMF packages and so forth for the poorest countries. It's been done through the Paris Club, and because a lot of the debt is government to government. But China has resisted this, and China is one of the biggest, if not the biggest, single country creditor I won't say emerging market countries, for the poor countries, right? The Belt and Road Initiative has built up a lot of investment, Chinese investment in those countries, some of which has not gone very well, has not paid off, but the Chinese want the payments on the debt. And it's complicated partly because a lot of the Chinese lending has not been by the Chinese state, but rather by its various development banks, a whole set of different banks, which makes things that much more complicated. China has not, perhaps for that reason, it's not clear, China has not been willing to play the cooperative game that governments have developed over decades in working together in the Paris Club to try to sort out the debt difficulties. And I think that's hugely unfortunate. And I would hope that China might eventually reconsider its position.
Well, it's so interesting that you bring that up because, I mean, just one example is the investment that the Chinese have made in the Eastern Horn of Africa, where they've done so many infrastructure projects, which is from a logistical perspective, such an important place in the world. And then, of course, you have, the growth prospects that the continent is looking at as it continues to grow and the middle class grows, and there's more opportunity via technology. So to your point, it is concerning. They're in such a strategic place where future growth is expected.
Oh, they've chosen the Belt and Road Initiative. They've chosen, despite the fact that this is supposedly the lending is coming from individual large Chinese state banks. Somehow the project have been chosen in strategic places, and in many cases, they were promising projects for ports and so on and so forth. But quite a number of them haven't turned out very well. And if the projects don't turn out very well, there are no proceeds to pay back the debts, and that has been that turns out to be the case for quite a number of countries now.
Right. And we've seen what happens, it's the country itself that suffers once these debts aren't paid and these larger countries do pull out. I mean, that's a big part of Africa's history.
It is, I'm afraid. Africa has a promising future ahead of it. It's just a little further ahead than we might like it to be.
All right, Professor Portis, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you very much.